Rohr here with an early concise highlight on Thursday, July 17th, 2014. It's currently 7 a.m. U.S. Central Time. So looking at what all this means to the S&P 500 future on the actual trading, the S&P is down about $10 today, back down into the 1965 area. This is important because it reinforces our instincts that this was a trading range market, even though it had gapped up as of Monday back up into the key resistance around the gap lower from the beginning of last week, from the high post close up at 1977.60 on July 3rd in response to the U.S. employment number, and the gap lower taking it back below the key top of the channel for that week, last week, at 1975. So while it did range up into that 1975 to 77.5 area, actually closing off that gap in the early trading yesterday on Wednesday, it could not get out to the upside, and that keeps a lid on the market for now. Lower supports are the up break at 1960, which we had highlighted coming in on Tuesday, after the up break on the kind of drift higher at the end of last week, but that is just one level in front of the more prominent 1955 to 53 support. Ultimately, we still feel the market would have to close below 50 to really look bad. Could not do so last Thursday when it opened below it, but then recovered so nicely. And if it should fail that mid to low 50s area, there is quite a bit of more prominent support at the overrun upside objective and other congestion and negated down breaks back in the 1938 to 34 area. And if it escapes to the upside for some reason, does get out above 1980-81 late this week, that's what it would need to do to liberate itself for a push up toward the 2000 area on the next oscillator resistance. And that pretty much does it for the short-term view of the S&P 500. Moving over to the intermediate-term view, what we have is a market that shows that overrun downside reversal and the gap up going back to the first of the month a couple weeks ago on Tuesday that overran that 1955 to 53 area. That's one of the reasons that remains some pretty good support, along with the tolerance down to about 50. The 9-week average is around 47, but that'll be moving up to somewhat above 50 for next week. Then we also have the lower support we've highlighted down around the 38 to 33 area, 38 to 35 area, which we'd at this point say includes this clear, fresh Fibonacci retracement at 34. So it's actually 1938 to 34 support. And you can see here the topping line this week, and it correlates well with an oscillator level of 135 over the 41-week average. So that's up around 1980-81 area as resistance.